You are watching the Elevation Mentor Show, and today I have a very special guest, Andrew. Thank you for being on the show.
I am so grateful for being here. Thank you for having me.
Okay, Andrew, I'm gonna have you start out by telling us who you are and what do you do.
Who am I? Well, I'm a multifamily investor in Massachusetts. I'm a property manager. I self-manage my properties. I'm also a real estate agent. And on top of that, I have a W-2 job as a project manager. So I
Oh,
definitely wear a lot of hats for sure. Yep.
okay, that's cool. So you're into a lot of different things.
I am. I am. And my main goal right now is to really expand my multifamily long-term rental portfolio. Currently have about 24 units, and I'm trying to close 20 this year. Mostly commercial. I'm kind of sticking with commercial, which are 5+ unit properties. So
Okay, that's cool. What's your background? You mentioned project management.
my background is, yeah, I have a project. I'm a project manager. I have a project management certification. And my background more kind of surrounds just a normal middle class mindset where, you try to get a good job at a good company, you try to make six figures, you buy apartment, and you think you made it, right? And then you come to realize that you might have 6, 12 months of reserves, but at the end of the day, you are paycheck to paycheck. You always got to go crawling back to that job. So I,
Mm.
I I essentially achieved the American dream by gaining all of those kind of benefits, and then I realized um, how dependent I was on that job, which scared me, and that's kind of what led me into real estate.
Okay, all right. Um, so can you talk a little bit more on why you chose real estate?
Yeah, I can absolutely do that. So I think like many people here, once you read Rich Dad Poor Dad, you kind of have a mindset shift. And that's exactly what happened to me is during COVID, I worked from home and I had a lot of time in my hands. So I decided to read Rich Dad Poor Dad. I'm in the book. It's all about, utilizing real estate to gain financial independence. And then I kind of looked at my net worth. I use Mint to track my net worth. And I realized, like, holy crap, 80% of my net worth is in my real estate. Maybe there is something to this real estate game. So from there, I kind of decided that I didn't want to work 30, 40 more years. That scared me to death, and kind of want to take a leap and get into real estate. And that's when I decided to take out a HELOC on my one-bedroom condo in Boston, move an hour away from Boston to Worcester, Massachusetts, where I started purchasing multifamily. A house hacked a couple, bought some investment, partnered on a couple. So that's kind of how I built my portfolio.
Okay, that's cool. And so, um, you already mentioned this, but what kind of real estate do you do? And can you talk about that, like what your portfolio looks like?
I absolutely can. So I do multifamily real estate. And I actually targeted a city that 30 to 40% of the stock on multifamily properties. So
Mm.
it was really easy to kind of build my portfolio. I know a lot of people try to target multis, but they target areas with it's very sparse multis, and it gets very challenging to get those. But more or less, the way I built my portfolio is I utilize HELOC, a home line of credit, to purchase two house hacks, about 40, 50K for my line of credit. I bought in a couple syndications with my line of credit, which cashed out and gave me more money down the road to buy multis. And I bought a couple investment properties all in HELOC money. And I split a couple commercial with some people as well. So more or less, I've utilized the equity in the property, in my multifamily property, to buy more property. And yeah, that's kind of how I built my portfolio, and that's kind of what my portfolio looks like. I have 7 properties, 24 units across those 7 properties.
Congratulations.
Thank you.
That is awesome. Um, so I want to get into the funding because people want to know how they're going to buy a property, where's the money coming from. So, um, okay, so you bought your first property, but then for somebody new, how did you get the second one?
So whenever I advise people about buying property, I always ask them, look at your entire net worth, right? And out of your net worth, how much of that net worth is just sitting there dead doing nothing, right? And that's kind of the methodology I took. Was most of my net worth, 80 to 90% of my net worth, was in this my equity that's providing me zero return. So the way I kind of the strategy I utilized was I wanted to transition that debt equity into assets that provide me cash flow. So I took a line of credit, converted that debt equity into multifamily properties that provided cash flow. So most people in middle class, a lot of their net worth sits in equity in their primary and their 401k. Both of those you can actually leverage to buy real estate, right? So most people, most middle class people, a lot of their net worth isn't spitting out passive income. But if you utilize that strategy where you can borrow against those funds of money and arbitrage those in the cash flowing real estate, that's how you build kind of wealth, in my opinion. So that's the strategy I took. Was I just kind of converted my 401k. Well, I haven't done it yet. I'm planning on doing it, and my equity into kind of buying cash flowing multifamily property, preferably near the 1% rule. Kind of what I'm aiming for.
Okay. So for the second property, you use a line of credit?
Yeah, so for the second property, I got my condo back in 2015 in Boston. And then I bought my first multifamily December 2020. I house hacked that with $40,000 for my line of credit and an FHA loan. So I didn't pay any money out of pocket. It was 100% grab from my line of credit. My second property was actually a syndication, which I don't know if your audience is familiar with a syndication, but essentially I bought into a percentage of an apartment building. It was a 132 unit building in Lowell, Massachusetts, which is the third largest city in Mass. And I took $65,000 from my line of credit and put it into this 132 unit building where I own 1% of the property. That was my second purchase, and that actually cashed out a year later. They sold the building. I think
Really?
they bought the building for 20 million. A year later, they sold it for 26 million. So in a year, I got like an 89% return on my money. So it was a pretty great investment for sure.
That's awesome. I never heard of them selling it so fast, like, because I'm used to them like selling it like 5 years later or something like that.
Yeah, totally. It was 100% timing. It was 100% timing. They also got a really good deal on it. But yeah, and they also, they got offers after they closed right away because they got such a great deal on it. But they actually waited a year, so your capital gains was at a lower rate. Because if they sold it within that first year, then we would have had to pay a lot more taxes, right? So it was kind of a strategic move, but more or less they bought right. And the building was in great shape. And in Massachusetts, there's not many 100-unit buildings, so it's definitely kind of a desired asset by institutional investors for sure. And I believe that's who bought us out. So
Okay. All right. So, Andrew, so back to the area of money, where this money coming from? Um, how do you create a repeatable source of income to keep buying property?
I think the simple answer is when it comes to building wealth, you can attack it from two sides. You can attack it from the expense side, or you can attack it from the income side, right? So my first plan of attack was reducing my expenses as much as possible. And I achieved that through house hacking. So my first house hack, I believe my mortgage was $3,200, and two of the three units brought me $3,200 in revenue per month. So I almost lived for free. And then as a result, my expenses went from $2,000 to $3,000 a month, and I make six figures in my salary, my W-2. I'm a real estate agent on the side. I self-manage my property. So all that additional money could be funneled back into buying real estate. Additionally, I also try to target properties that I own. Any equity that I have, I try to figure out ways to get that out, be it a rental line of credit, a home line of credit, maybe a refinance. But what can I do to get that equity, that debt equity, not giving me any return, get that out and arbitrage that into buying more real estate. So it was very much just spending very little, making a good money, and not allowing life creep to happen, reinvesting all that back into real estate and just letting it all compound. So that's kind of been my journey, more or less.
Okay. So you probably already talked about this, but how do you scale? Just to repeat.
How do I scale? So when it comes to scaling, I believe people really need to, before they ask how do you scale, you got to ask what sort of time frame are you looking to scale? Like if you're looking to scale within 3 to 5 years, you're going to have to take actions that are gonna put you in extremely uncomfortable scenarios that you have to be fine with if you're going to do that. However, if you're trying to scale in 10 to 15 years, you could take a more slow approach to that, right? So I'll just give you a quick example. I wanted to scale quick. I wanted to get out of my 9 to 5 in 5 to 10 years. The way I actually achieved that was I actually uprooted my entire life from Boston, Massachusetts, and I moved to an entirely new city, an hour away, where I knew nobody, I had no family out there, but they had a bunch of multis at a decent price that provided good rents, right? So due to that, like I knew I wanted to achieve financial independence, but as a result, I had to put myself in extremely uncomfortable scenarios to achieve it so quick. So first, you kind of have to understand your timeline, and if you want to do it quicker, you have to be comfortable with doing things that other people are unwilling to do. The next is kind of assessing what tools do you have available. Where does your net worth lie, right? Do you have a lot of money in your 401k? Do you have a lot of money in equity? Maybe you have a strong network that you could arbitrage that and buy real estate. But what are your strengths? What tools do you have available? And how can you utilize that to buy more property? The next is like you got to choose a niche, right? Like riches are in the niches. You can't buy multis in 30 different zip codes. You really have to focus on, I'm trying to buy multis in this condition, in this price range, in this zip code, and go a mile deep. That's how you find deals. The next is like, if you can borrow money, you got to figure out where you can borrow money and how you can arbitrage that into higher returns, right? So, like a quick example of that would be maybe I can borrow against my 401k at 5 or 6%, right? If I'm utilizing that money to buy a rental project that gives me an 8, 9, 10% return, that's how wealth is built, right? Next is you got to take action. Like you got to be ready to strike, and when a great deal comes by your desk, you got to be able to put the offer in and get it under contract. The good deals go quick, so you have to have your money ready to go and be ready to strike. And then the last thing is you gotta have daily habits that get you closer to your goal. Like how many properties are you underwriting per day? How many offers are you making per day? How many brokers are you reaching out to? How many lenders are you reaching out to? Right? Like you got to do all this stuff on a consistent basis to get the deal. So that's kind of the approach I took to kind of growing my portfolio.
Okay. So I heard a lot, but the main thing that stuck out with me is getting uncomfortable because it's not comfortable.
I mean, you don't know how many times I hear people say like, "Oh, I want to reach financial independence. I want a house hack, but oh, I have 2 kids and a wife. I can't do that." You absolutely can house hack with 2 kids and a wife. You just don't want to. So you just got to put yourself in uncomfortable scenarios if you're trying to grow. And I mean, it's just not even like an uncomfortable living scenario. You have even just to grow as a person. Anything you're uncomfortable with, you gotta face it head on, and it's got to make you a stronger and better person in the long run.
Okay. All right. So I did hear a lot of good things. What is your timeline for becoming financially free? Getting uncomfortable, and then you have to get a niche. It has to be a particular niche. You can borrow money, borrow from your 401k, and be like taking consistent action. So that's what I heard you say.
Exactly, and more like a portfolio architect, your portfolio construction. Like I said, take a look at your net worth in general and see what part of your net worth is spitting out dividends, spitting out cash flow, right? If you have 90% of your net worth just sitting there dead, you might want to consider reallocating that into assets that provide returns or dividends, right? Because the only way you're going to reach financial independence is if you achieve some sort of dividend producing asset. Like you need as many dividend producing assets as possible. Could be a stock, could be real estate, could be a syndication, could be part of an oil refinery. You could syndicate an oil refinery, like whatever it is, like that's what you need to focus on that. And then once you kind of achieve that, then you can kind of breathe and figure out what I want to do next. But I mean, that's more the approach I took is all of my net worth wasn't giving me any cash flow. And I kind of transitioned all of it to real estate. So yeah.
Okay, Andrew. Okay, for somebody who is new, say that they have one house and they're trying to get um, a multifamily. How would you recommend them going from one house to a multifamily?
So if they have one house, I would figure out how are you going to get money out of that house to buy more property? Do you have to refinance? Do you have to do a HELOC? How are you going to arbitrage your equity to buy more property? Additionally, utilize owner occupied loans. I mean, you can get into a property with 3, 5% down. Like if you just had to bring a normal down payment for an investment loan, it's 20 to 25%. So you can get a house for 25% of the cost as opposed to going for an investment. So, utilizing those two strategies alone can definitely, if you have a ton of equity, you might be able to house hack a property and buy an investment property on that line of credit. You might up your units to, you buy 2, 3 units, you might up your units to 6 units in 1 year if you do that correctly. And that's exactly what I did. That first year, I believe I bought one house hack and I bought one investment property with my line of credit. So within 1 year, I went from 1 unit to 7 units. So
That is awesome. That's awesome. So, Andrew, what is your favorite book?
my favorite books. I have a lot of favorite books. Um, what I'd recommend for your audience, if they are trying to get into multifamily, is Brandon Turner and Brian Murray have some really good bigger pockets books. I believe it's the Multifamily Millionaire, Volume 1 and 2. Volume 1 is more aimed towards small and medium multis. Volume 2 is aimed towards that larger stuff, like that syndication I mentioned earlier. But reading those books will give you a good understanding of how to underwrite properties, how to understand what's a good property and what's not a good property, and how to manage it. And just gives you the full picture on how to kind of obtain these assets and run them up to stuff. So
Okay.
from properties in and around Worcester, Massachusetts. I'm also an agent, so I'm definitely happy to serve you if you are looking for that service.
Okay. Sounds good. And then the last question, do you have any last words for the audience?
My last words, I would say, is you gotta have a really deep and burning desire to really go after real estate. It's something that you gotta go all in to really be successful at. So it's not something you can do an hour here, an hour there. It's something you gotta go all in, right? So if you're trying to scale, if you're trying to reach financial independence in a short period, you got to figure out a way to eliminate the dead weight, like the Netflix or whatever it is that eats your time, and arbitrage that or utilize that into tasks that get you closer to your goal.
Okay. Go all in.
Yep.
All right, Andrew. Well, thank you for being on the show and sharing your story with us.
Thank you for having me. I really appreciate it.